let's get started. Welcome, everyone. I want to welcome you all to our third financial session, Becoming Credit Smart, Part 1. Note that we will have our second session next week, Tuesday, at the same time, Part 2. So it'll be good that you attend that one as well. Before I get started, I'd like to do the L.E.A.D acknowledgement. As treaty peoples on Turtle Island, we are obligated to uphold treaties made from a long time ago. Where I'm situated, I would like to acknowledge the traditional territories of the Mississaugas of Scugog Island First Nation, the Mississauga peoples, and the treaty territory of the Chippewas of Georgina Island First Nation. I also want to thank the First Peoples for their ongoing teaching of how we are to learn on the land and from the land in partnership with each other, the animals and the plants. We are very lucky this evening to have Jean Garraway as our presenter. Jean is a mortgage agent with Dominion Lending Centers. She has a BCom from York University. She retired from the banking industry where she spent over 30 years in various branch manager roles. Her passion is to help individuals take charge of their finances. And I can attest because she has been instrumental for me and helping me in very many deals. So without further ado, Jean, take the floor.
Oh, thank you, Astrid. Good evening, everyone. As Astrid says, I'm Jean Garraway, and I'm really happy to be here tonight to speak to each and every one of you. So welcome to Becoming Credit Smart. Okay, so far, the sessions that we've had, the financial sessions, because we've had other sessions as well. Our past financial sessions were on budgeting. Astrid Breedy was really helpful on that. She worked on a webinar called Budgeting Like a Boss. And the next session we had was Pierre on investing. And today our focus is going to be on credit. So my goal today is to show you how to adopt wise credit principles to enable yourself to improve on your personal financial picture. There are 4 basic principles in personal finance. It's budgeting, as we've had already, investing, credit, and protection. If you are credit smart, your budgeting, investing, credit, and protection activities will protect you and your family for life. And when I say for life, I mean for life. Okay. So before we get into all this, I think one of the things that we can do is define finance, because what we are discussing here is all about finance. So finance is defined as the management of money, which includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. Now, having good financial management skill really is good for optimal financial wellness, okay? And as my little chart on the side here says, you're dealing with the spiritual, emotional, intellectual, physical, social, and environmental. Finances can really affect you in all these different areas. Some people who are not managing their finances well can suffer from things such as, insomnia. Some of my clients have come to me and they say, Jean, I'm having sleepless nights because I'm not in charge of my finances. There could be weight gain or weight loss in some situations, depression, suicide. I'm sure we've all heard of people who have committed suicide because, their finances got so overwhelming that they couldn't manage it. There's anxiety, relationship issues. One of the finances has a lot to do with a lot of relationships actually that have gone sideways. One of the sorry about that. Some people have a lot of relationship issues when they have financial management problems. Okay, sorry about that. Social withdrawal is also another challenge that you can have where, you just totally withdraw from society because you really don't feel like communicating with anyone because your finances is so overwhelming. Physical ailments, it could cause financial problems can cause health issues. and also unhealthy coping methods. So those are all some of the things that can happen when, you're out of control with your money management skills. So, in order to use credit wisely, we have to really educate ourselves on credit. Um, when I was in banking, I spent 35 years in bank, managing several banks. And sometimes when clients come in, if you look at this picture on the side here, and I'd ask them, how is everything going today? And they'd hold their heads like, oh my God, this is too much. It's overwhelming, you know. And so a lot of people will say, credit is really not my thing. Some will say, I know nothing about money. Please help me. And some would prefer if someone else handles the finances. In some families, it could be the husband that takes care of all the finances. And in others, it's the female, the wife that handles it. And some just say, you know what, it's plain old, just too stressful, can't handle it. So I just want to, bring up this quote that I saw on the internet, and it's from George Washington. And he said, to contract new debts is not the way to pay old ones. We have a lot of clients sometimes who, a lot of people would pay, one debt by increasing another, take money from one visa and pay it on the other. When you get to this point, that there's something wrong. But George Washington says, to contract new debts is not the way to pay old ones, but I have my own slant on this. Contracting new debts could be a good thing if you are consolidating to reduce interest costs and monthly payments, thereby simplifying your finances, which allows you to pay off debts much quicker. So, what is credit? This is what we're going to get into. Okay. Credit can be defined as your borrowing reputation. It paints a picture of your payment history. Credit provides the lender or the bank with information regarding the likelihood of your ability to pay. It is also your risk factor, and your risk factor is determined by a credit score. So, before we get into the nitty gritty of credit, we have to look at something called the 5 C's of credit. I'm sure some of you have heard of it before. When you're hired in the financial field, that's the first thing they teach you. The 5 C's of credit. So, what is the 5 C's of credit? It's how financial institutions determine if a client is credit worthy or not. Should credit be extended to a client? And if so, what type of credit? It is really your credit scorecard. So when we look at the 5 C's of credit, we look at these 5 areas. We look at collateral, which is your property type. If you're getting a mortgage, they look at the property, where it's located, how marketable is a property, right? A property that's in the city, like suburban downtown Toronto, would be, preferable for a lender compared to a property that's, say, in Windsor, Ontario. When we look at credit, we're looking at the Beacon score. A lot of you know about Equifax or TransUnion. You'll be looking at the Beacon score, looking at your past history, right? And any issues or risk that is associated with your credit. For capacity, we're looking at the ability to repay the loan. This is really important. That's the first question that a lender would ask. Does this client have the ability to repay this loan? Capital, that is the amount of money that you have. How secure is this client? If you're buying a house, it's your down payment amount, or where is the down payment coming from? Is the client borrowing it, or did they save it over the last 5 years, for example? Character is also very important. What is this client's willingness to repay the loan? The integrity. Is the employment stable? Residence is also another thing that they look at. Does this client move 3 times a year, or have they been in that residence for the past 16 years? So those are some of the things that they look at. Now, let's take a more detailed look of these 5 C's. So number one, let's look at capacity. As the picture says there, is the glass half full or half empty, right? So capacity measures the borrower's ability to repay the loan by comparing income to debts. Can the borrower generate adequate cash to repay the loan in case their cash flow is interrupted? And when we talk about cash flow being interrupted, we all know what that's all about now in COVID, right? There are a lot of individuals out there who have lost their jobs, or maybe their hours at work is decreased, so there is some interruption, that is caused by what's happening right now. We also have to determine one's debt to income ratio. And the debt to income ratio determines the amount of risk that each client presents. Now, let's talk about debt to income ratio a little more. Most lenders have specific ratios that they use. The debt to income ratio is basically the amount of debts to your income. That's what they look at. For example, Harold pays $400 a month in debts and has income of $1,000 for simplicity's sake, okay? His debt to income ratio will then be 40% because you're, 400 divided by 1,000, 40%. So when we look at debt to income ratio, most banks will generally use a total debt to income ratio between 40 and 42%. Okay, capital. That refers to the net worth of a client or a business, savings or investments. And in the case of a business, you talk about retained earnings. So when you look at capital, you ask the question, is the borrower adequately capitalized to withstand income interruption? Do they have enough money to float them through? Okay. So let me ask the audience, what are some of the factors that could cause an interruption in income? Can anyone share some answers with me here? Oh, I can't hear
Co-
anyone. Oh,
COVID,
okay, great.
COVID, losing my job.
Absolutely, absolutely. Anything else? Astrid, how about Astrid?
Illness.
Yes, that's right. Okay. Well, let's look at some of them. I don't have a very chatty bunch tonight, but I'm sure
Oh
there
no,
are.
you have Yulika who said emergencies. Hassan has said getting fire. Bell saying illness and hospitalization. All great answers.
Awesome. Yes, for sure. So, some people said loss of jobs, some said illnesses. Maternity leave is another one. A lot of people a lot of women who find themselves on maternity leave at half their income, that could be, even though they're still getting income, but it's some sort of interruption because they're not really getting, the full amount. And sometimes that can really cause, some issues as far as income interruption is concerned. So COVID-19 wars, as you say, uninsured illness, a lot of clients are not insured. They don't have insurance on their mortgages or their, different loans. And, that could create a problem. Poor planning is also could create income interruption. Spending outside of your budget. Unexpected expenses can also be considered as income interruptions, because if you were to go to the mall and have, one of those 2-hour binge shopping sessions, that certainly is, outside of your budget because you're not planning on it. And it certainly can create problems when it comes to making your monthly obligations. Now let's look at character. Character, and this is one that most of my clients have a problem with. They never really consider that this is important when you're, doing a credit application. Character refers to a borrower's reputation on financial matters. Past behavior is the best predictor of future behavior. And that is one that lenders really subscribe to. They're looking at the client thinking, is this person going to be paying, the money as prescribed over the next 5 years? So that refers to your willingness to repay the loan. How honest and how reliable is the individual? What about employment history? How stable is it? Right? How about residents? Are they moving all the time? When it comes to employment history, that is something that a lot of lenders would be looking at right now. For example, with COVID, a person that is probably maybe a nurse might be, someone that a lender would love to lend to because they have they have no problems as far as their employment is concerned. But if we were to look at someone working in retail, there might be a problem there because either their hours are cut or they've lost their jobs. Period. Right. So as my little blurb over here, it says good lifestyle choices develop good character. And that's pretty much what it's all about. Now let's look at collateral. Assets pledged as security. That's what collateral is all about. Lenders prefer secured credit versus unsecured credit. Of course, because if it's secured, they can always cash out what is held as collateral and pay themselves just in case the client defaults. The quality of the collateral is also very important to a lender. If I were a lender, I would love to have a house as a collateral versus a car loan, even though a car loan, a car is collateral for a car loan, but there are, varying qualities of collaterals. Any suggestions as to the different types of collateral that we can have? Is there anyone else who want to share this? Or Pierre, I can't see
You can't see? No, Bell just said real estate, which is excellent.
Yes, excellent.
Kasana,
Yes, it
I
is.
saw also homes, Kasana saying. Anybody else?
So let's take a look at the collateral that I have.
Jewelry.
We have two different types.
So
Julie, what did
Winsome
she
is
say?
saying jewelry. What would you say about jewelry, Jean?
Jewelry. Well, you know what, jewelry, I'm going to come up with that actually. That's on my list. So let me describe, there are two types of collateral. One is called easily accessible collateral. We call it readily realizable collateral, but I thought I'd make it a little easier, so it's easily accessible collateral and not as easily accessible collateral, two different categories. So an easily accessible collateral would be something like a non-registered GIC. If you default, you can always cash it out and, pay the loan off, no problem. Mutual funds, bonds, stocks, TFSA, you can get at a TFSA easily. It's not locked in. If it's, say, in a savings account. Gold is also a collateral. You can always cash out your gold stocks. Home equity, you can have a home equity line of credit, and that has equity in it. And you can readily access the cash in a HELOC, via a HELOC. Now, there are some other collateral that is not as easily accessible, such as an RSP, for example. And, we can't really use RSP, like a bank cannot use an RSP as collateral. But when it comes to a client's character, they will probably say, okay, I've lost my job. I still have to pay my bills, and therefore I can cash out my RSPs, right? And there will be taxes involved. But if someone has RSPs, the bank can't really go and cash it out without their permission, right? So that's what I mean when I say it's not easily accessible. Now, cars, boats, jewelry, artwork, life insurance policies, all those things could be seen as collateral, but they're not as easily accessible. So I hope I was able to explain the difference between the two. Okay, so I just need a little action here from the group. Which is the best collateral and why? So you have a rich aunt and she wanted to give you something, and it's one of these three: a boat, a yacht, I should say, for 1.2 million, a house, $780,000 is the value, or some Facebook stocks, 300 Facebook stocks worth $774,000. As of the time I was writing this, that's what the 3,000 Facebook stock was equal. Well, that's the amount that it was valued at. So who wants to take a shot at this? Which one would you take and why would you take? And there's no right or wrong answers, guys.
So Dinah is saying the house. Kasana is saying real estate because they have mortgages. Curtis is asking. I'll answer that
Or take
after
the yacht,
Curtis
I'm
about,
sure.
yeah,
What did
Curtis.
Curtis say?
Curtis is saying why are RSPs not accessible? I'll give you the quick and short. Curtis is what anything that is registered with the government, they will not allow you to use it as collateral. The RSP, when it first came out in the early 1990s, was intended for retirement. They've made some exceptions for the RSP homebuyers plan, but the government does not allow you to use RSPs as collateral. If you do so, you will deregister it and there'll be tax implications. So it's a no-no on that aspect.
Legally, it's
Yeah,
not, it cannot be
yeah.
cashed out and satisfy any debt at all, the lenders. Okay, great. So those were some good answers, right? Some think that if you were to choose a house, if it has a mortgage on it, will be paid off one day in the future, but the value always goes up. Some may say the yacht. Some may say, look, I can cash out the yacht, sell the yacht, and get the $1 million. It'll be worth more than the 780. But the thing is, the yacht is a depreciating asset, just like a car. So even though it's worth 1.2 million right now, 10 years from now, it won't be worth that for sure, but the house will certainly be worth more. And you can still say the same thing with the stock. I mean, it could be, if Facebook is viable 20 years from now, it could be worth a lot more. But just in case something happens, technology, someone comes along and knocks Facebook off their feet, it may not be worth 774,000. So I hope this gives you a good idea of, collateral, what is a better type of collateral versus others that may be depreciating as time goes by. Okay, so credit, number 5. Credit can be defined as your borrowing reputation. It paints a picture of your payment history. Credit provides the lender with information regarding the likelihood of your ability to pay. Credit measures your risk factor, and some lenders consider condition of the economy and how it could affect your credit. For example, right now, COVID, we come back to COVID all the time, but when a company, for example, is borrowing money, condition of the economy is something that is really on top of mind. If you were a lender right now, Pierre, would you be lending to a restaurant? You'd be scratching your head going, right? Okay, all right. So
E- Even the best of times, I might not even been lending to a restaurant.
that's right. Maybe that was the good
Yeah.
example. Anyway, so we've talked about the 5 C's of credit, and all this information is captured on a scorecard, right? And the scorecard now gives you a credit score. So, you can look at a range of credit scores from, say, 300 to 900. And if you're looking at, over 700 to about 900, you can consider yourself having very good credit to excellent credit. If you are about 650 to 719, and I'm just talking about Equifax credit scores here, guys, this is considered good to lenders. Over 650, you can pretty much get what you want. You can buy a house, you know, get your loans, no problem, at reasonable rates. When you look at 600 to 649, this is considered fair credit. Now, it doesn't necessarily mean that you're not going to get credit. You will get credit, but you're going to pay a little more for it. And when you look at scores between 300 and 599, the credit needs some work. Okay, you're going to pay a lot for your credit. There are 2 basic types of credit: secured, unsecured. When we look at secured, we're talking about your home, a secured credit card, or a car. Okay. When we look at unsecured, you're looking like credit card, Visa, unsecured loans, line of credit. Okay. So that's 2 basic types of credit. And now we're going to go into 4 forms of credit. First one I want to talk about is a revolving credit. This is where you are assigned a maximum limit on your credit. This is the most common form of credit issued by credit card companies such as Visa, MasterCard, and store and gas cards. Credit cards are considered unsecured credit because there is no collateral securing the amount borrowed. Charge cards. This form of credit is often mistaken to be the same as a revolving credit card, right, such as a Visa. The major difference between a credit card and a charge card is that the credit card can carry a balance, whereas the charge card must be paid off in full each month, or that is what they would like you to do. If the balance is not paid on time and in full, penalty fees will be added. So American Express is an example of a well-known charge card. So this form of credit is advantageous against accumulating credit card debt. And this is my favorite credit option, guys. Now let's look at installment. Installment credit involves a set amount borrowed, a set monthly payment, and a set time frame for repayment, such as a car loan. Interest charges are predetermined and calculated into the set monthly payments. Common forms of installment credit agreements are home mortgages and auto loans. They're typically secured, some of them can be. The borrower must provide collateral in some cases, such as a mortgage or a car loan, to guarantee repayment. But there are those that are unsecured. Okay, so a home is an example of a collateral on a mortgage and a vehicle on an auto loan. If the borrower were to default, the home or vehicle would be repossessed. Then we can look at service credit. This form of credit allows the borrower to pay for a service, such as a membership, okay, say at a later date. Payment is due monthly. So examples of this is like a cell phone, gas or electricity, water, that kind of agreement. I remember when I bought a house in the US, and I went down, I didn't really have, a electric bill down there before. And when I called Florida Power and Electricity, FPL, I think it's called, I had to pay $200 as a deposit, and I got it back after a year. So that's, a form of credit, service credit. I didn't have, a track record with them, so they'll sometimes ask for a down payment. I think they do that some in Canada somewhat on, I think, cell phones maybe, right? I think so, right, Pierre? I think they do. On a new, maybe a new person that's graduating from university or
that is correct.
Yeah. Okay, so I would like to have a little chat session with a few people. I've chosen a few individuals to talk about the different kinds of credit, right? So we have the credit card, the charge card, the installment loan, secured line of credit, HELOC, and secured credit card. So the first person I'd like to call upon is Astrid. Astrid, you were assigned a credit card.
Well, a credit card is, I think, one of the best options for myself because I'm very disciplined when it comes to my spending. And I'm also a budgeter. So like I'm the kind of person that plans for major expenses in advance. What I also like about the credit card that myself and my husband has, it's one where we collect travel points. No, we don't spend money just to get the travel points, but we can use the travel points because we have to buy stuff, everyday stuff. But what I do, and I've gotten into the habit, is I never carry a balance. So when I make a purchase, I pay it off and I don't put more on that card that I can't pay. So based on my spending habits and what I use the credit card for, the Visa credit card is the best option for myself.
Awesome. And, are we saying that if you're not disciplined, you can't have a credit card? Absolutely not. We're just saying that if you are disciplined with credit, a Visa credit card would be good for you because you won't be abusing it. You won't be, if the card limit is $5,000, running it up to $4,999 and then eventually get into trouble. So a person who is disciplined, who will spend money on the card and pay it off right away, that is ideally how you should use a credit card such as Visa. Okay, so what about Eleanor? You are going to be speaking on the Amex card. Is Eleanor around?
No? You know what? I'll give you an example of bad credit. Astrid is
Yeah.
good credit. I'll give an example. So when early in my 20s, when I started to do well, and I wanted to show my mom how well I was doing. So I took her out to a restaurant, her and my brother, and the bill came, and I wanted to show off and put my credit card on the table and say I'm taking care of it. And my mom, being a good old, good fashioned Haitian mom, never owned a credit card in her life. I think the only card that she had was an Eaton's card. So she saw that I put the credit card down, and she put the money on the table, because she said to me, well, I said, no, mom, I'm taking care of you. And she goes, well, I guess you have no money. Because to me, people that use, credit card
Credit
means
card.
you don't have the money to pay it right now. So I will pay it right now, and then you could pay me back later. So that was a lesson that was taught, trying to be a big shot, but in the end, right, I wasn't going to use credit wisely. So that always stuck with me.
Yeah, that's right. No, Eleanor is not here, but I can read
Is
her.
she? Okay, go
Oh,
ahead,
she
Jane.
is?
She is.
Eleanor is here? Oh, okay. Read
Hi
on, my
there.
friend.
Okay.
Eleanor, you're on board. Come on. Let's hear
Okay.
it. Amex.
So Amex. Okay, so this is the person, and I just want to be clear, it's not me, Pierre. Okay, Jean's got me for this, but there
You're
is,
role playing, honey.
yes, we're role playing. So there's
Okay.
a high income earner who works full time and has a business on the side, but they pretty much spend it all. And after their last debt consolidation, their advisor suggested an Amex card, and it has helped because they have to pay it off every month and they don't get punished. And when they don't, they get punished with high rates, which is true about the Amex card. And you see it immediately, but you wouldn't see that with another card. And so it helps to keep them on track. And this is a person who gets high when they spend money on retail therapy, and they're not financially disciplined. Now, the only thing about that and me is that I love retail therapy. I think we all do.
Oh,
Not
yes.
that we can do any of it right now, but yes, retail therapy is a high. So I think the good thing is that the Amex card shows you immediately what you have to pay, and you have to be more disciplined because you know that you're going to get hit with a very high rate. Right, Jean?
Exactly. Thank you so much. Very well done. Thank you. How about installment loan, Pierre? Mr. Tomachek, are you
All
ready?
right. Yes, I'm ready. Yes, so
You're
I,
next.
I am playing a role. So I am not only disciplined, I am smart. That's not me. So I'm not that smart. I have
That means
educated
play a
myself.
role.
I'm playing a role. I have educated myself on finances, and I know that an installment loan is the best way to pay out a debt. I was offered a line of credit, which I had a lower rate, and my wife wanted us to take the line of credit, but I decided that I wanted to pay this out at a set period in the future. Most people who use a line of credit to pay out debt never do. I know that because I've been paying this debt religiously over the last 4.5 years. And in 6 months, I can invest this money in a mutual fund account.
Excellent. That's right. Right. And, it has been studied over and over again that people who take a open form of credit, such as a line of credit, always just reuse it over and over again, and they never pay it off. Some people, not all, but most do. Okay, let's go to the wonderful Yulika on line of credit.
Hi, everyone. So I have line of credit. So essentially, I am a business owner and I buy different car parts and I sell them for a profit. Although I don't actually buy car parts, I've been thinking about maybe buying like different components for like gift boxes and selling them for a profit. So I feel like this example really kind of struck a chord. So next up, I never know when I'm going to need credit. So I need an open credit facility that I can draw upon and pay off at any moment's notice. I'm young, I do not have a house, but I was told by my banker that I can actually invest 10K in a GIC and create a secured LOC or line of credit for myself. Then I'll be able to borrow money at a cheaper rate, and I'll definitely be looking into that.
Awesome. Great. Good stuff. Okay. And now we have Natasha. Is Natasha around?
I
Okay,
am
so-
here. I
Oh,
don't
awesome.
see
Hi,
the
Natasha.
TV, however.
So you
Hi.
were talking about secured credit cards.
Sure. I'm actually on the road right now and I had to park to join you
no.
guys. So I will go ahead. I'm reading from my phone.
Yes, go right ahead.
Okay, so with the secured credit card, retail therapy has taught me a lot. The good feelings last only a few minutes, but the debt stays forever. I found myself in a financial mess and had to declare bankruptcy. I was advised that if I got a couple of secured credit cards and used it wisely, I could improve my credit score. So I'm actually trying to become more disciplined so I can actually be able to purchase my home in the future.
Awesome. Great.
So
So I hope everybody's getting an idea of, the different type of client profile that matches with each of these credit products. Now I'm going to do the HELOC, and I am Mrs. Know-it-all. See, I can play the role, Eleanor. I paid out my mortgage a few years back. Then I borrowed $500,000 to help my new beau invest in a restaurant. The restaurant went bankrupt. I was in a car accident 3 months ago, and unfortunately, my private insurance lapsed as I stopped making payments. I was thinking that my work insurance would be enough, but it was not. I now have a mortgage payment and I'm working 2 jobs, and my ex-beau has now opened his second restaurant with his new fiance. The only good thing about this situation is I am paying prime plus a half, which is 2.95. It could be worse. So I will be calling Pierre for some advice, as he's not only disciplined, he's also smart. I'll be calling you on Monday, Pierre. So I hope that gives everybody a good idea of, the different kinds of credit product and, who it's suitable for. But of course, you can pretty much apply for whatever you want. But at least how, if you have a credit card, how to use it, right? Not to go overboard and get carried away with points. And next thing you know, your card is over the limit and you're coming to someone like me as a mortgage agent to help you out because, you have overspent. Okay, so let's go to the next screen. Why is my screen frozen?
Let's see.
Here, my screen is frozen. What's going on?
Okay, hold on. Let's see.
Is that because you were
No, I didn't
the
touch
last
it.
time?
No, try it.
Let me escape. I don't know. Oh,
There you go.
okay, all right. Okay, let's continue. So I usually define credit in 2 different categories, good versus bad credit. And that's just my thing, my take. A lot of times when someone has bad credit, we usually, use a different terminology, challenge credit, bruise credit. I just call it bad credit because that's what it is. And if we know we have bad credit, we're going to try to do something about it. So under bad credit in red here, I have a car loan. Now, some people may say it's not because I'm actually taking out a loan and that car helps me to get to work. But the reason why I put it under the bad credit section is because a car is a depreciating asset, and it really gives you nothing, tell you the truth. A credit card could be the same thing. It could be abused. A second mortgage is also under the bad credit category because it means that you are not qualifying in the A space. We're going to talk about the A space later on. And therefore you have to go, to a broker to get a high rate second mortgage or private mortgage. Okay. Payday loan. I'm sure you have all been watching the 6 o'clock news over the last 2 weeks about the payday loan companies such as Fairstone. The other one I think is City Financial. All those payday loan companies, their rates are really high. And if you're at the point where you have to go to a payday loan company to borrow, you know that there is trouble ahead. Okay. Some of those companies, it's like a revolving door, from one payday loan to another. And it can become a problem. So I have that under the bad credit category. Overdraft protection is also under my bad credit category because I always encourage clients, even when I was in the bank, even though we were supposed to sell overdraft protection, I always encourage client, if you don't need overdraft protection, don't get it because, all of a sudden, most people sometimes will be living off their overdraft protection. And that is something like an Amex card where you should be paying off your balances at the end of the month, but that sometimes never happens. So all those I put under the bad credit category. Now let's look at good credit. Mortgage. A mortgage is what I would call good credit because once you pay the loan, over the long term, you'll be paying down your loan and the property value goes up. It appreciates in value in the long term. It's one of the best investments you could ever have. An investment loan is also good credit because you're borrowing money to invest. You could be borrowing money to buy a rental property. It's a good thing. Now, notice that second mortgages and private mortgages are on my good credit section because at this point, you are a lender, not a borrower. And that's a good thing. And we're going to talk more about those in credit part 2. When you have that great credit, what are some of the options that are available to you, right? An Amex charge card, I would call good credit because if you're using it wisely, you're going to be paying it out every month. Let's look at what causes bad credit. Using your card for everyday purchase, using your card, sorry about that. Using your card for everyday expenses and not being able to pay off balances right away. As Astrid says, you have to be disciplined when you have a credit card, not just go out there and, blow your budget in 1 2-hour shopping spree like Eleanor would do, right, Eleanor? Credit shopping is also not a very good thing. Feeling too comfortable with credit. There are clients who credit doesn't bother them. My mother was one of those people. Oh, you have to have credit. How are you going to develop your credit if you don't, And she would have 12 credit cards and would be spending them all and, juggling to pay them off at the end of the month. Late or missed payments. For example, if you have a Visa card and you pay late or you miss your payments, you pay, once every 3 months, not a good thing. And a lot of clients are not really aware of what those, R1, R2, R3, R4s, what they mean until they get to the point where they're applying for a mortgage or a loan and they realize that these late or slow payments really hurt their credit. Maxing out a credit card is also not a very good thing. If you ignore, your debt utilization limits, if you have a credit card for say $5,000, and once that credit card is over 50% of this limit, it really decreases your credit score. I was in a Equifax webinar about 3 weeks ago, and I was told by the person who did the webinar that if you maxed out your credit card, it could affect your credit score by as much as 100 points. I've been in this business a long time, and I never knew it would affect it by that much. I thought maybe about 30 points, but it can affect your credit score up to 100 points. Chasing after credit card points. I know when I was in banking in the banks, there were studies that spoke about these points cards. For example, it takes about 90,000 points on certain credit cards to go to Europe from Toronto, for example. you would have to spend $90,000 on your card to get one of those trips. And my point is this: why not just pay $900 to $1,200 to go to Europe, than to psychologically, like these points card registers that need in your brain psychologically to go out there and spend, because you are going to be earning these lovely points, but they're not such a good idea. Another thing is not keeping track of your credit score. A lot of clients would come to me for mortgages, and I'd ask them, do you know what your credit score is? And they go, oh yeah, it's great. And then I pull it and it's 630. And they're not aware of why it's that way. There are certain companies that you can use to keep track of your credit score. One is Credit Karma. I think another is Mogo. But everybody has access to those on online banking. In all the banks, 5 major chartered banks have access to those companies that you can literally go and set up a profile. And every January, you'll get a little text saying, congratulations, your credit score is 720. It's great to have. The other thing, the other good thing about keeping track of your credit score is when you set up a profile with Credit Karma, for example, it sends you a text every time someone hits your credit bureau, which is a good thing. So if someone is, if identity theft is going on there, it's very easy to, call the lender and find out, hey, what's going on? Someone just pulled my credit bureau and I'm not in your office. So, that's a really good way of keeping track of what's happening with your credit. Buying a new car versus an old one at the wrong time. Now, I'm not here saying do not buy your Maserati. That's not my point. But there are some times when young, graduates, especially people who are just graduating from high school or college or university, the first thing they do is they run out and buy that shiny sports car. And, the minute you drive that car off the lot, it's depreciated for one. And the retail therapy thing is gone after about 6 months, if, could be even earlier. So therefore, buying a new car versus buying a used car at that point for that individual may not be such a good thing, because if you are paying $800 to $1,200 a month for a car, it's going to really create a problem when you're ready to qualify for a home, unless you're a very high income earner, then that doesn't matter. Large student loans is another one. Now, I'm not saying, when you choose the choice of institution that some students choose, sometimes they regret it. Now, I'm not saying, if you want to be an engineer, then you should go out of town, choose the best university. That's not my point. My point is, over the last 30 years, sitting in front of new graduates, sometimes, they have $60,000 or $80,000 in student loans. And they regret it because they're thinking, I still haven't found the job that I really wanted. And I could have stayed at home, go to University of Toronto or York University and stay at home, and, life would be a lot easier. So, that's something, you should really look at. These large student loans can really be a problem over the long term, because people take a long time to pay for them. Always making minimum payments on your credit cards. You will never, ever pay it off. Astrid spoke about this in her budgeting session. If you make minimum payments on your credit card, you'll be a grandmother before you finish paying it off. Let's just say that. That's how long it will take you to pay it off. So it's always good to be disciplined and pay off as soon as you make an expense, as soon as you purchase something. But in case you have to carry a balance, try to make more than your minimum payment, and always make your payment before your payment date. Co-signing for someone is also not a good idea. If you do not want to lose your friends or family members, do not co-sign for them. And this is something that I've seen over the last few years. A lot of people have lost some good friends because they've co-signed for cars, and the person just stopped paying. Not sticking to your budget and goals is also, last but not least, of something that could cause you to enter the tunnel of bad credit. Okay. Now, I just want to share a little something. I was at a webinar about 3 weeks ago, an Equifax seminar, and it was quite interesting what I learned. Some of the stuff I knew, but others I didn't know, such as what I spoke about, keeping your utilization, your credit utilization limit low. You need to keep it below 50%. I was dealing with a client once, and her credit score, I called her about 6 months before her mortgage was due. And she said everything was good. Great, great, no worries. So I thought, let me call her 3 months before the mortgage maturity date. And I did. I pulled her credit bureau. She said it was great, but her credit bureau was 630. So I could not get that mortgage that I was looking to get for her because your score had to be over 650. So what I did right away, she had 3 credit cards, 2 were over the limit, 1 was almost right at the limit. And what we did was we got a loan for her. It was at Fairstone, one of those companies that had really high interest rates, but that was the option at the time. We got the loan, we paid down all 3 credit cards below 50% of the limit. And in 48 days, I counted it, her credit score went from 630 to 720. It was awesome. So I was able to get her 1.95 for 5 years on her mortgage versus 3.99%. Okay. So keeping your utilization limit below 50% is a good thing. Declaring bankruptcy twice stays on your credit bureau for 10 years. So keep that in mind, guys. Okay. Another thing that I learned during the session is during this COVID period over the last year, fraud increased quite a bit. They said from January 2019 to July 2020, there was a 46% increase in fraudulent activity, right? And that's basically because of the increased usage of digital channels. Everybody's buying on Amazon, right? So what really stood out to me is that the age segment most targeted was people who were younger than 24 years because they were too comfortable sharing their information more information that they should. Okay, it's like, oh, well, yeah, sure, I'll give you this information, right? So they were a part of the 46% increase. And of course, the other age group was 65 years and over because, a lot of them are unfamiliar and somewhat forced to use online channels. So that was interesting. I thought I'd share that with you. So we talked about the different types of credit and how the credit score, all the 5 C's of credit, all the different information is captured on a scorecard. And, you get all that information is captured on a scorecard, and that spits out your credit score, right? From 3 to 900. Now, let's look at the 3 types of credit profiles. This is just the way I arranged it, right? Just to, share it with you. So there are 3 types of credit. You have, say, your A credit, your B credit, and your C credit. The A credit is the person that has over a 650 credit score. Remember we talked about that? And the debt to income ratio under 44%. Now that's a stretch, 44. It's really, 42%. But you can stretch it to about 44. That's where the banks will look at you, or all the A lenders will look at you, right? Now, if it's over 44%, say the score is under 650 and the debt to income ratio is under 50%, right? You're now in the B credit arena. And anything else, say you've declared bankruptcy or anything like that, you are in the C market, okay? So let's keep going. Now, when you compare rates for good and bad credit, this is what you're looking at, guys. It's really important to ensure that you try to keep yourself in that A category as much as you can, right? Not having too high a debt load and keeping your credit score above 650. 700 is better, but over 650, you can get pretty much what you want. Now, if you are an A client and you're looking for a mortgage, say you have 5% down, you can get about 1.65% right now on your mortgage rate. If you're looking for a loan, you can get about 9 to 12%. Okay. If you are in the B space and you're looking for a mortgage, you're not only looking at 20% down, you can't put down 5% anymore. You have to put down, say, 20%, and you're looking at a rate of between 3.69 to 6.99%, depending on the lender you go to. When you think about going for a loan for, say, let's just say Fairstone, you're looking at about 33 to 56%. And as a matter of fact, if you were to go to some of those payday loan companies, goodness, it could be as much as 400% when you look at all the service fees and the interest rate combined. If say you've just declared bankruptcy, you can still get a mortgage, but you're looking at private lenders who will charge you between 7 to 15% for your interest rate. And for loans, you're still looking at the same 33 to 56%. So as you can see, your credit really takes you a long way as far as interest rate is concerned. It can save you a lot of money, if you are a client. What is that really all about now? Let's see. What does this really mean? For example, if you have a mortgage of, say, $400,000, what would it cost you? If you are an A borrower and you have a 5-year mortgage at 1.65, the interest over a 5-year period would be $30,199. If you were a C borrower borrowing at, say, 7%, you'd be looking at $132,278 in interest over a 5-year period. What a difference, $102,000 over a 5-year period. How could a family utilize this kind of money over 5 years? That's a question. How, if you had that extra money, what are some of the things that you could do for you, yourself, and your family? Any suggestions? Hello, Pierre.
We're going to Vegas.
Really, eh? Credit card.
Pay down my credit card. Cassandra has a good way. Pay for college. Hassan is saying
Yes.
cover food costs. You guys are all sound. You make some sound investment. Or Adrian says invested. All excellent. Don't go to Vegas with me.
Yes.
You'll lose your money.
Awesome. Okay, so let's look
No,
at
we're
some of the things we
investing and
could
there's
do.
a beach there somewhere, Jean.
Exactly. You could help with your kids' tuition for sure, right? You could invest in an RESP. That's something a lot of families do not look at. You can get up to 20%. What is it that I'm saying? 20%. Here, help me out here. You can get a 20%.
The savings grant.
Yeah, the savings grant,
Yeah.
20% up to, on certain amounts when you invest in an RESP. Why would you not want to take advantage of something like that? 20% is a good rate of return, You could buy insurance to protect your family assets. So many households in Canada right now are either have no insurance or are underinsured. That is, something that you could use, that you can do with this $102,000. You can start a savings account. You can start an investment portfolio. You can take that long needed family vacation. I remember back in the days when I was a single parent, I couldn't even spell vacation, much less to take one, So it's so important, guys, to really look after your credit. People don't really think about how credit affects them and how much more they're paying when they're a B or a C client. So, if you know better, why not, help your children who are just leaving school, sit down and talk to them, and guide them in the right direction so they won't make these mistakes and they won't be, paying that much more than the average rich person, because most of them have good credit and they get the best rates. Okay, so what do we know so far, right? So we're coming to the end of our session here. Having good credit is important, very important. It's good to know that credit can be fixed or improved. Do not be afraid to ask for help. You know, I have over the years had people walk into my office at the bank and they are so ashamed, because they have bad credit. And, there are some clients who are in the B space, remember A, B, and C credit? They're in the B space and they stay there forever, not knowing that they can fix their credit and get to the A space. Look at that client that came to me with the 630 beacon score, right? If they had come to me 2 weeks before and I had to rush to get the mortgage, they would have been stuck with 3.99% when it took 48 days and a little common sense to rearrange her credit, her credit card balances to get her back to that A space. And most clients who are, say, in the B credit realm, just keep renewing their mortgage or their loans or whatever, in that space. Many clients who go to Fairstone to take out that loan at 33% can qualify in the B space with a company called Community Trust at 6.99%. They just don't know it. That's why it's important to educate yourself in credit to see what is out there and what's available for you. Because there are some people out there who are just, it's a revolving door in the B credit space when it doesn't take much for them to help, to resuscitate their credit so they can move to the A space. Okay. So my advice, guys, is, education is important, knowledge is important. And, my last statement here says, stop giving all your money to this dude here that has all the golden coins in his chest. Okay, so that is the end of my session. I wanted to play a video, but it's not working. So, what I could do is just
Jean, before you leave, can you, because I have gone through
No,
this.
I'm not going to leave. We're actually, anyone who wants to ask questions, we're going to do a little question and answer session.
I've gone through this so many times with people, but can you please explain to people why it's so important that they contact a broker well in advance of them, for example, say buying a house, and why you would go to a broker versus going to a bank? Because you hear people say, well, I went to a bank and, this is the rate that they're offering me. And you say to them, well, why didn't you go to a broker? They could have shopped you around and gotten you a better rate. So can you explain to people why they would go to a broker versus going to just one bank?
Okay, well, thank you so much for advertising me there, Eleanor. I love it. Didn't want to toot my horn too much, but yes, that is one of the biggest challenge that we have in our industry. A lot of people think that the A market is banks only, the 5 major banks. Now, you can get a great rate to start out with at the bank. They will give you a great rate to just get you in. Once they get you in, they're going to lock their horns on you. Come retirement, renewal date, you are not going to get that great rate anymore. The brokers, we have in the broker market over 150 lenders, and a lot of them are A lenders. Some of them have A and B side, where they have they can service the A clients and they can service the B clients as well. Companies such as First National, my company, DLC, have Paradigm, B2B, all those companies have great rates. They can give you a good 0.25% less, and that adds up to a lot over 25 or 30 years. The problem that we get is, I know when I was in the bank, we would tell our clients that if you go to a broker, you're going to pay fees. Now, that is true. 50% of half of that is true. If you have credit that is challenged, if you have bad credit, yes, you will pay fees. Say your credit score is 540. I can get you a mortgage at a trust company, but you're going to be paying, maybe 2.99 to 3.99, and you're also going to be paying 1% fee. That is the cost of doing business with a client that presents more risk. But at the same time, if you are a client, I can get you a great rate with no fees. But a lot of people think that when you go to a broker, you pay fees, and it's not necessarily true. If you are an A client, the lender will pay us. So the best thing to do is to do your mortgage shopping with a mortgage agent or a mortgage broker, because you get the best of both worlds. I'll tell you another problem that some clients have. Say, for example, your credit score, a lot of clients go from bank to bank and shop, not knowing that every time they go to a bank and they pull their credit bureau, it reduces their credit score. And you may go to a bank and realize that your credit is not, your credit score isn't really there. You're not over 650. And just that one pull, or if you go to, say, 3 banks and they pull it 3 times, your credit score could be lower than where a B lender would accept you. So it's better to go to a mortgage broker, because we pull your credit bureau once and we can use it for a period of 30 days, and we can send it to 150 lenders. Not that I will be doing that. And it's still the same credit score, still one pull, right? So you get the best of both worlds when you go to a broker. Now, another thing that you should be aware of is not all mortgage broker or mortgage agent is the same. You know, some are just starting out, and some have, a lot of experience and can really help you. The other thing is, whereas I, as a mortgage broker, successful in the business, you have done very well with your volume, you know, business, we have more access to more lenders. And some mortgage agents that are just starting out, don't want to say anything bad about them or anything, but you have to be careful, because not all mortgage agents have access to all the lenders. And that's important, right? Because if they do not have access to all the lenders, you're going to get the rate of the lenders that they have access to, which may not necessarily be the best rate. There are some clients out there who would come to me for a mortgage and they have 14.99%, and I have access to a lender that can give them 6.99%. So therefore, that's where education and knowledge is important. So when it comes to, shopping for credit, whether loans, credit cards, or mortgages, it's best to deal with a mortgage agent, because you get the best of both worlds. So I hope I wasn't too long on that one, Eleanor, but thank you for asking that question, because it's really important. What other questions do you have? Wow. No more questions.
Actually, we had a few that
Okay.
that was online. I think someone just raised their hand. So who raised their hand?
It
I think
was
it was
me, Adika John.
Go for
Go
it.
ahead.
Okay, all right. I wasn't sure if you hear me, but I just want to inquire what may be the best credit card to have when you are now kind of in that A credit zone. So I'm now kind of entering there, and I'm kind of wanting to change the credit card that I've had to something better. Like as you were mentioning, Credit Karma. I have something like that, and they always advertise a whole list of new credit cards that I'm eligible to now have, but I'm not exactly sure which one would be the best for me.
When you're choosing a credit card, it really depends on you as a client. Just like when Pierre gave that session on investments, when we did the KYC, know your client, you have to know yourself and know what's, important to you. Are you a business person that travels a lot? If you are disciplined with credit, maybe a travel card would be good for you, because every time you travel, you earn points, right? So that is one thing. If you are a student just graduating, maybe a cashback card would be good for you. Or they may be interested in a card where there's no annual fees, right? Because the travel card, for example, annual fee could be $110, $120 a year. But there are some cards, for a student, for example, they're just starting off, maybe they have a part-time job, they may not need that high-powered travel card with points, right? They may just need a card with no annual fee that probably gives them cash back or grocery points, right? So the best thing to do is ask yourself, what is important for me? What is important to me as a credit card client? And go into, a bank website and just take a look. You can actually pull up a comparison tool and take a look at the different credit cards and go, which of these cards are important? Do I want a gas card? Do I want a points card? Am I interested in getting cash back every year? So, or if you are an A client, as you say you are, maybe you're interested in a card that has a low interest rate, right? Some clients who make maybe over $60,000 a year and, is interested in a points card of some sort, could also qualify for a low rate. Instead of 19.9%, you could be getting 12%, right? So those are the things that you should consider when you're looking for a card. Ask yourself, what's important to me?
Excellent. Couple of questions. Well, one thing, and this is just me, I would never pay any more for an annual fee for a card. So if they're gonna offer me something, it's got to be without an annual fee. Couple of questions. I think Renee wants your information, Jean. So I don't know if you could put on the screen your there we go, perfect. And if you want to just leave it there. Um, another question would be from Yulika, who wants to know what scenario is it better to buy or lease a car? It's one of those, it depends, right, Jean?
Yeah, true. Yeah. Well, based on my experience, it's better to buy a car. If you're self-employed, a lease might be a better way to go because you can write off the expenses. But as far as cost is concerned, I'll tell you a little joke. I knew a person that was a general manager of a well-known car dealership, and he said, "Jean, I love the Black female customers. They're the best." I said, "Why?" He says, "They're so easy." Whatever you write on the form, they'll take it. They're so pleasant. They're so nice. I can sell them a $30,000 car for $36,000, no problem. And I said, "You have met my sister-in-law." But, and I said, "And what's the next?" He says, "A Black male." And he said, "Who would I, don't take this, no way." He says, "Who would I not want to sell to?" He says, "The East Asian guys, boy, they're tough. They get me every time. They really have good negotiating skills. They're the best when it comes to that, But when you are buying a car, clients always used to come in, to my office. I don't know, Pierre, if you've ever experienced this. Clients would come in and they go, "I need a loan for $45,000. And I said, "Who would you like it payable to?" Honda. And I would ask them, "What car are you buying?" "Oh yeah, I'm buying this car with all the bells and whistles and I just love it." So I said to them, "Why don't you go back and ask them what the cash price is?" And I swore, when that woman went back and asked what the cash price is, she saved $9,000. Okay, because they will tell you zero, get a car at 0% financing. Well, you are paying for that. Don't let the 0% fool you. Ask them, what is the cash price? And you'll always get a better price. Then you come into the bank, get the loan, and take that money and give it to them.
Another thing that you should consider when you're buying and leasing a car is your driving habits. Because normally
Mhm.
with leases, there's a maximum number of kilometers that they let you do annually. And if you go over that, you're paying through your nose like so many cents per kilometer. So you
Good
really
point.
have to look at what your driving habits are when it comes to leasing a car, or whether you want to buy it as well.
And also your lifestyle too, because if when you lease a car, if you're a smoker, they'll nib you for that. Little nicks on your car, they really charge you, for that. And also if you get little dents on your car, it may not be your fault. Somebody else is smashing your car in the parking lot, right?
Mhm.
So when you take that back after your 4 or 5 years, they really can deduct quite a bit of money in cost for that lease car. Yeah, very good point, Astrid.
Yeah.
Yes.
Jean, I just wanted to jump in. That was a great point, Astrid, on the mileage, because that's a heavy cost that most people don't realize. The thing that I wanted to point out, Jean, and just go back to was you talked about whether you should buy a new car or an older car. And I think I've had this conversation with I don't know how many young people where they want to get that first car, they want it to be new, but they don't realize how great the depreciation cost is. And so I want you to run through that again, because I always tell young people, I know you want to take that, $30,000 that you saved up. I remember a friend and her fiance, I was talking to them and they were, planning on getting married. And this young man, he had saved up $45,000 towards his new Lexus. And I thought he had a hole in his head, because why would you not take that $45,000 and put it into an appreciating asset versus a depreciating? Well, the car's not an asset as far as I'm concerned, but
It's a depreciating asset.
but put it into something that was appreciating versus something that's depreciating. So can you just go through that and how it works for young people? Because it's always something that I wrestle with when I see young people sporting these brand new, wonderful cars. And I'm thinking, well, I'm a hell of a lot older than you, and I sure as hell make a lot more money than you, and I would not buy that.
True. I think the challenge when young adults graduate from, say, college or university, and they start off maybe with a job, say they're making $65,000 a year, right? The first thing they really think about is the car, and it's the sports car. And what they have to think about is the cost to maintain that car. Insurance, very expensive, because guess what? A young male pays so much more, right, than a young female. But the fact that they're young, period, they pay more for that shiny sports car versus a used Honda Civic. So that's something to think about. And I always I told my grandson, he wanted to buy that, and he actually talked me into buying the shiny sports car, because he did so well in university, and I co-signed for him. But after 6 years, 6 months, that aura wears off, because you're thinking about the high payment on the loan, the high payment on insurance. It's usually a sports car. Gas is more expensive, right? If you're buying a Mercedes or whatever, premium gas, right? All that, and the car is depreciating as we speak, right? Now, if you were to compare that, right? Say that individual would save up some money. And I remember a client bought a house in 2002 for $283,000. And as we speak today, that house is worth over $1 million, right? And, when you think about the money that that young person would put out on a monthly basis, would almost be the same as what that person is paying on a mortgage. But the difference is that car is now, well, he's on his second car. It's not worth anything anymore. But that house is worth $1 million, and the person is well on their way to pay off the mortgage, right? So it really is important for the young adults to think about the impact of maybe qualifying for a mortgage when you have a very large car loan. You know, I do a lot of pre-approvals for clients, and when we do the mortgage application and you take out just the car payment, they qualify.
Hmm.
But with the car payment there, they have to wait until they pay off the car or sell the car, you know, which is unfortunate. So again, education or knowledge is important. How credit affects you is important. And what I would like all the young adults to do, go to a bank website, go to mortgages, go to pre-qualifying for a mortgage, go into one of the calculators, just fill in all the information and see how much your salary and your debt payments, how much that qualifies you for. It would be an eye opener. And I think if every young adult who is just graduating from, you know, post-secondary school would do that, it would really keep them on track, just like an Amex card would keep you on track, right?
Hmm.
Because when you know what you qualify for, and if buying a home, for example, is a future, it's something that you desire to have, you can see, you know, why you should buy that expensive car or not. You know, it really keeps you on track and it helps you along the right path as far as achieving your dreams and your goals.
And another
Perfect.
thing I just want to jump in here as far as buying a car. A lot of the times where those car companies really make money is not on the sale of the car, but in the maintenance of the car.
Hmm.
So when you have your brand new car and you have to, if you want to keep that warranty up to date, you better make sure that you have to take it to them. And you could come away with paying 800 to thousands of dollars just on a regular maintenance. So that's another thing that you have to be aware of. A lot of these car companies, you may get a deal on the car, but they know they're going to get you back on the maintenance and
Hmm.
stuff that you have to buy through them throughout the time you
Dollars
own the
for a
car.
great job, you know? You're right. Absolutely. Thank you for
Being
that, Astrid.
being the
Mhm.
sole guy on this panel, and my love of cars, here's a couple of rule of thumb. In the first year, a car depreciates 20%. So if you're gonna buy a car, don't buy you could buy a newer car. So buy the same car, but a few months older or a year older. You're gonna save a whole lot more money. In the 5 years that you're going to own the car, that car is going to depreciate 50%. So first year, 20%, every year thereafter, an extra 10%. So you could depending on what you want to buy or lease, you could do pretty well by buying a car that's maybe 1 or 2 years old. Um, I don't know, Yulika, if we answered your question from buying or leasing, if it's better. Again, I think from what Gina said, it's gonna depend. Either option, if you are a small business owner, you have the ability to write off the interest on either the loan interest if you get a car loan at the bank, or the leasing costs if you're leasing at a finance company. So it will definitely depend on you. One other question from DF. Gene, how many credit cards is good to have?
One. No, you know what? It's interesting. I remembered once when I was in banking and I was going to coach my staff. And I said, how are you preparing for this meeting? And he says, oh, I'm so excited to tell you about this. This client spends $1,200 on Starbucks coffee. Can you believe that? And he said, after the meeting, I said, so how did it go? He says, it's interesting. I told the client that she spent $1,200 on Starbucks coffee, and she said, no way. That means she wasn't even looking at, she didn't attend Astrid's session, Budgeting Like a Boss, right? And it's interesting, a lot of times we really don't know what we're doing. It's good to look at our checking account to see what our activities are. So the answer to your question, and that same client, my staff told me, had 12 credit cards. And she was in for a debt consolidation, and he said he had to pull them out of the wallet for her. She couldn't even pull them out herself. He said he pulled them out and he cut them up in front of her. Guys, you only need one credit card. You really do. You know, I remember, and I'm one of those too. When I retired from banking, I think I pulled out about 12 credit cards out of my wallet as well. The lucky thing is they didn't have anything on them. And I cut them up and I called the credit card company and I asked them to close it off. But, you can have more than one credit card. And if you're disciplined, if you're a high income earner, you may have different credit cards for different needs. And if you can manage it, that's fine. You know where the problem starts. Things happen. COVID happens. Never expected it. No one asked for COVID. But all of a sudden, you have 5 cards with balances on them and you've lost your job, right? Now, a lot of people are not aware, but you can get disability insurance or payment protector insurance on credit cards, disability insurance on loans, mortgages. But a lot of people do not take out that sort of protection, So, if you had 3 cards and they were, up to the limit, they're owing $40,000 on them, and you had balance protector insurance, you lost your job, you're in a car accident, whatever the case may be, the company will pay your monthly payments for you. But how many people are sufficiently insured? Not too many. And that's where you can have problems if you have too many credit cards with balances on them. And even having too many credit cards without balances on them can be dangerous, because when you lose your job, guess what? You're going to start buying groceries on them. So my answer is choose a card, figure out what kind of personality you are. We did that little exercise, figure out the credit facility that is right for you. Stick with that one. And when things get rough, you won't have to pay 3 or 4 or 12 credit cards. You're only paying one.
Perfect.
Jean, it's Natasha. I just have an extension to that question while preparing for a mortgage. So if I'm preparing to take out a mortgage and then I need to be able to get qualified based off of my credit history or how I was paying before, do lenders normally need two different lines of credit to be able to qualify you, or is it just one line of credit that they're looking at, or how are they looking at it?
Very good question. Actually, Natasha Coley is a broker. She's a realtor, right? With what is the company you work with, Natalie? Natasha?
It's EXT Realty.
EXT Realty. I really like her because she does a lot of sessions on Facebook. So look out for Natasha. Very good question. The reason why I said we only need one credit if things are great with you is because it helps you being in control. A lot of people think that they have to have several credit cards to develop their credit. You can literally develop your credit as a young person, say graduating from school. And I'm going to get to your point, Natasha. If you are just graduating from school, if your parents will have you, if you're disciplined, your parents can put you on their credit card, and you can actually develop your credit that way. So you don't even need a credit card to develop your credit. A car loan helps you develop your credit. If you feel that you're an individual that just love to shop, retail therapy is all that, and you're 24 years old, I would advise you to perhaps just, attach yourself to your parents' credit card. That could help. But what Natasha is referring to is if someone has, say, challenge credit. Say you had a proposal and it takes it, you can get, it stays on your credit bureau for 3 years, and you can get credit if you reestablish your credit after 2 years. Now, if you are in that situation and you go to, say, Home Trust or City Financial to get a secured credit card, which means you have $1,000, you give it to them in cash, they use it as security, and they give you a credit card for $1,000. Now, you will, take that credit card and you'll spend and use it wisely, which means you will buy $50 in gas and you'll pay it off when you go home. Take it from your checking account. So the purchases that you make, you pay it off right away, right? One credit card will not help you. You need two, right? In that situation, so that they can see how you manage credit, right? Now, if you have a car loan that you're paying off as well, that helps, right? You won't have a line of credit because if you have declared bankruptcy, you wouldn't have that line of credit anymore, right? So it depends on your client profile. If you are developing your credit, it's better to have two credit cards that you are using carefully. You're being credit smart with it. But if you are just an individual just graduating from school, you don't have to go out there and get 2, 3 credit cards to develop your credit. A lot of people think so, and it gets them into more trouble because, when you're going to school, the credit card companies just bombard you with credit application. And of course, many kids, young adults, they take them, right? It's fun, but it's just not a good idea. So if you're ever in the situation to advise a young adult, please advise them against that. Did I answer your question, Natasha?
Yes, you did. Thank you. I appreciate it.
Thank you.
Perfect. Sorry, Jean. I have Adrian, who's about to leave, and he had a question, a hypothetical situation. If you have, let's say, $10,000 in debt, is it smarter to pay off $500 per month or invest 250 in the stock market and pay off your credit card with the other 250? I know what I would say. I'll just let you answer that.
Well, it's always good to pay off your credit, your
Yeah.
debt. Always good too. And I guess the buzzword is stock market. You can win or lose. And usually when you have debt, you lose quicker than you win, right? Especially if you're young and you're not experienced. But yes, I would pay off the credit first. Now, some people, when we look at individuals who have a home, that's credit, right? And a lot of people, really, especially older folks, will advise you that it's best to pay off your mortgage. So a lot of clients put everything that they can on their mortgage and they forget about savings. That is not a good idea. You should always take a balanced approach when it comes to, paying down your mortgage and saving at the same time. But for this gentleman who asked the question, if I have $10,000 in debt, should I, instead of paying $500 a month, should I put $250 a month in the stock market? And if you said mutual funds or ETF, maybe I would, say something else. But I would definitely pay down that $10,000, especially if it's on a credit card.
Exactly, because the reality is you're going to pay about 20% in credit card debt, so that's after tax. So in order for you to generate an after-tax return of 20%, you would have to do in excess of 30% on the stock market in whatever stock. And there's no one there, and I know I will never say that to my clients. I cannot make you 30% on an annual basis. If you can, more power to you. I will always pay off the debt.
Thank you, Jean, for a very, very informative session. I learned a lot in this session, and I'm sure everyone on the session that was on the session tonight has learned a lot. And so thank you very much. I want to remind everyone of our session next week at the same time, 7 to 8. And please register for that session. So we look forward to having you there. Everybody stay safe and have a good night.